What is up, Theta Mafia guys? How are we doing, guys? Looking at the week, guys, we're down 6.5%. That's crazy. We're down $4,000. This is a decent sized drop, guys, but we're still up 17% for the past month. The markets, they're down too a little bit. We got the SPY for the past day, they're almost down 2%. For the past week, they're down 2%. We look at the Dow Jones, they're down almost 3%. For the past day, they're down almost 2%. We look at Invesco QQQ, they're down 2%, and almost for the past week, they're down 2.5%. So, guys, the market's just, it's going down, right? Now, are we entering bear market time? My personal opinion, I think we are going to enter a bear market time. It's just going to be slow downtrend overall, kind of like what we've seen in 2021/22. We started at a peak and then we just start going down over and over time. I don't think it's going to be fast like how 2020 was. I think it's going to be a slow downtrend overall. Now, with that being said, guys, I got 4 strategies for you guys to, one, reduce risk. The second one is how to scale and build out a portfolio. And the third and fourth one, how to have insurance on your stocks, and also how to make income in a downward market monthly. Okay, so let's hop into it. So 2 types of risk that I identify when we start getting into bear market territory, and one is margin. So I use margin, guys. Some of you guys don't. If you don't, that's good. I recommend it for people that are experienced. I don't recommend it for new people. So I have been in the markets for almost a decade. I know what I'm doing, right? For some of you guys that only been in here for like 2 months, I do not recommend margin, right? Understand market cycles, understand, how your portfolio works and what you're trying to do. And then maybe a few years down the road, you can get into some margin, okay? So I got an individual cash of almost 11 grand. The margin total that I'm using right now is 20K. Robinhood lets me borrow up to 44,000 for available margin, but I only use 20K. I got a total of buying power, $7,167 left. Now, my margin risk status, I am low risk. My buffer's almost 40% or 23K. And that shows you how much a buffer I have before I get into high risk and I get margin called, right? And you don't want to experience a margin call, okay? You just don't. Now, the second thing is portfolio diversity. So if we sit here and we look at Palantir, Palantir is 52% of my portfolio diversity. So that tells me that Palantir is basically half my portfolio. And the reason why is because we have, a big run up in Palantir. Okay. But I already shaved off 200 shares of Palantir because it used to be 90%. But I shaved 200 shares off of Palantir. We dropped it down to 52. We bought some other positions, right? And which knocked it down even more, right? And I got $10,000 in cash that still has to be used, plus the extra $20,000 in margin that still has technically be used. So I'm not really worried about my portfolio diversity and Palantir. Proper portfolio diversity, I think, will be 5 to 10%, maybe 15 to 20% on ultra bullish stocks that you're bullish on, right? But I think 5 to 10% is appropriate for that. Okay, so that's how we reduce our risk: portfolio diversity and a margin. Okay, next, the second thing is you're going to want to build a portfolio emergency fund. Okay, so I have one. I use SoFi, right? And the reason why we want to do that, guys, is simply for the fact that in down times, it's also good to have stored up cash. Warren Buffett, his cash, if you look right now, is at all-time highs. Why? Because when times like this happens, or downtrend markets, and when I mean times like this, if you look at my portfolio right now, and you're seeing it, when times like that happens and people are down 57%, or the ETFs are down 20 or 30%, that's where Warren Buffett's going to come out here and start picking up shares. Why? Because everything's cheap and he has a sheer amount of cash. And so you want to have a sheer amount of cash too. So that's why I recommend an emergency fund for your stock market portfolio. I run my stock like a business, okay? I have money coming in from selling options, and I have expenses going out. Whether that be maybe a losing trade or my Qualtrim, which I use to analyze stocks and stuff like that, okay? And so I analyze it like a business, okay? Now, you want to have a emergency fund for your business, just like you have an emergency fund for your person, okay? So, how much that is up to you and up to your portfolio size. I think a proper emergency fund for how big my portfolio size would probably be at least 10 to 15,000. But since my portfolio shot up so much, within this past year, 38,000, I don't have that. Okay, and that's just me being honest with you guys. I have a few grand saved up in a special area. Okay, a few grand, and I'm being modest about that. Okay, but I don't have nearly the amount of emergency fund that I want to have, but that's fine. Okay, but you do want to have some type of emergency fund. And that leads me to the third thing. When we do enter bear market or market corrections, like have you seen in 2022, we just start going down over time. You want a dollar cost average into positions, right? But you also want a dollar cost average with your emergency fund and the extra money that you might put in during the market crash or the bear market. For example, look at this screenshot. I said for this example, we have what? $10,000. If the market drops 5%, I'm going to put $2,000 in the market, right? Or 20%. If the market drops another 5%, I'm going to sit here and put another $2,000 in, or 20% of my portfolio emergency fund, okay? And I want to keep on doing that until I run out of money, right? And as I run out of money, you're like, King, well, I don't have that much money left in my fund. Well, you should still be saving money every single month, rather be $250 or $500 or whatever, and still be putting that in the markets every single month, okay? So the fund is there just for downward markets. You don't want to use the fund for bull markets, right? Bull markets, you don't use the fund. For only bear markets, you want to use the fund. When that bear market happens and you're depleted, you want to take what you would put into your emergency fund, and you also want to put that into your stocks at times. So there might be times where you're depositing, let's say the market drops 5%, like what we said, okay? And you're coming out here and you just put $2,000 in, and then you also saved up $500 from your job a month, and you can put that in. So there might be times where you're putting $2,000 or $2,500 in. It really depends. It just really depends, okay? So you want to also, in bear markets, dollar cost average, right? And you want to use your portfolio emergency fund during those times as well. This is the fourth thing. How can we hedge and how can we make money during times like this? So one strategy, I'll show you guys one strategy that I like to do and I make money off of, and it's a hedge, is sell covered calls. So if we look at Palantir, here's one. My strike price is $145 call on Palantir. Palantir's price is currently $100. If we look at the intrinsic value, right, I pretty much got an average credit of 1004. So we kind of bought it somewhere around here, okay? Now, Palantir was trading good, and then what? Palantir just dropped. So the intrinsic value went down. Why? Because if we look at my stimulate my returns, the further that Palantir's price gets away, the faster and faster that we reach that max profit, okay? Basically, covered calls are good when the market's going down. More than likely, you're not going to have to sell your shares. You get to keep your shares, and you get to make money over time. Now, what you're probably going to have to do is keep on averaging down. So after this $145 call, and let's say Palantir just keeps on going down, I might have to come out here and do maybe 120, or maybe come out here and do 100. You know, it just really depends on how far Palantir drops. Selling covered calls is good insurance, and you're making monthly income doing it. But also another thing that I like to do is sell cash secured puts. So if you have the cash, you can do cash secured puts, but if you have the shares, and remember, one contract equals 100 shares, so you need to at least have 100 shares to do this type of stuff, right? But if you have the shares, you can do covered calls, but if you have the cash, you can sell cash secured puts. And so what happens is people are going to sit here and want to buy puts on certain stocks, or on pretty much a lot of stocks. And the reason why is because if the market's falling, right, if you buy a put, that means you're betting the stock's going to go down, right? And so the buyers need somebody to sell it to them, okay? And so this is where you come in. You can sell puts and try to get into the company that you want for cheaper. So if we look at the share price of SoFi right now, it's $14.77. Okay? Now, let's say, well, we still think, SoFi is going to go down because we're in a bear market. You can come out here and do something like, 14. Let's do 14. Okay, 32 out of 100 times, but we still make over 2% of our money. And I'm sitting here thinking like, okay, if it does go down, am I comfortable buying SoFi at $14? Yep. And I get to collect the premium. If it reaches $14 or lower, we have to buy the shares at $14. If it stays above, guess what? We get to keep the premium and we get our collateral back, which would be cash in this case, okay? And we'll just keep on doing that. So if the stock just keeps on going down and down, we're just going to keep on trading cash secure puts lower and lower. Now, this is the thing. This is the thing, guys. The cool thing about this is option premiums get higher in a bear market when you're selling puts. Now, when you're selling covered calls, they're higher in a bull market. So it's good. You have one for one side and one for the other. So when you're selling puts, the premiums are higher, right? Because of market volatility, but also because the buyers need a seller to sell it to them. And that's where you come in, okay? And so these puts over here, right? These puts over here, 34-cent put, 37-cent put, it gets higher and higher over time because there's more people buying put options. And so therefore they need a seller. And so you can make a lot of money just selling puts from people that are trying to buy from you. And so you can still make monthly income in a down market. Guys, please watch the next video because I'll teach you how to hedge, and we'll do another strategy, and we'll go a little bit more in depth on that. Guys, we went over how to reduce risk, build an emergency fund, how to dollar cost average, and how to get monthly income in a downward market. Guys, please like, comment, subscribe, guys. I love you guys. Peace.